Well, good morning. It's Tuesday, September 10th, and the market is now 2 days above the 50-day moving average. The S&P is now 2 days clear above the 50-day moving average. And the question is, are we going to go higher or are we going to go lower or are we just going to drift ahead? There's two fundamental factors involved right now that are driving this market. First of all, investors are waiting for global central banks to see if they're going to take actions. I don't think there are because there's very little wiggle room there. The second factor is trade war and whether Fed is going to lower rates again next month. It's very possible. It's not out of the realm of possibilities, especially because the market is pricing it in already. So it looks like there's a fair chance for the market to go higher, but not so fast. Let me show you something eye-opening, and I mean eye-opening. This is the broad market. This is not the S&P 500. This is the broad market, the overall stock market. Right now, 49% of stocks, 49% of stocks are trading above the 200-day moving average. All right? That means 51% of stocks are trading below the 200-day moving average. The 200-day moving average is a very important barometer of whether stocks are bullish or bearish. Now, when you look at the S&P 500, almost 70% of stocks are trading above the 200-day moving average. Again, look at the numbers. 49% versus 67%. That's like 28% difference. That's telling us, pay attention, that's telling us that the S&P 500 is either grossly overvalued in comparison to the broad market or that the broad market is grossly undervalued in comparison to the S&P 500. Now, the S&P 500 only has 500 stocks. The broad market has thousands of stocks. And overall, over time, the S&P's correlation to the broad market's about 98%. So who do you think is going to win this fight? The S&P or the broad market? That's the 200-day line. That's a very fundamental barometer of whether markets are bullish or bearish. Now, let me show you something else more eye-opening. This is the percentage of stocks in the S&P trading above the 20-day moving average. And this is a short-term momentum indicator to let us know if stocks are getting tired or not. This is eye-opening. Pay attention to this. Let me show you this on a line chart. It's just easier to read. Now, this is percentage of stocks trading above the 20-day moving average. Look at it over a 5-year period. What happens when about 80 to 90% of stocks trade above the S&P, above the 20-day moving average in the S&P? We turn back lower. We peaked at about 85th percentile. Look at this chart here. 1 time, 2 times. In 5 years, folks, in 5 years, we went above this momentum level 3 times. Right here, and right there. Every other time in 5 years, when over 80% of stocks in the S&P 500, so that's over 400 stocks in the S&P 500, went above the 20-day moving average, the market cooled off. Right now, we went 87, and the market appears to be cooling off. So we have several factors that are telling us the market is ready to cool off. The percentage of stocks in the overall stock market, only 49% above the 200-day moving average compared to, let me show you this again, compared to 67% in the S&P 500, and almost 80% of stocks in the S&P 500 are trading above the 20-day moving average. And historically, when we go above 85, 86, 90, we tank. What I'm telling you right now is that the S&P 500 is grossly overvalued in comparison to the broad market in the short term, and that the rubber band in the S&P is stretched out. This isn't my theory. This is based on momentum and market internals. Talk to you guys soon. Expect congestion and mild downside. Take care. I'll give you guys a heads up tomorrow. Again, if you guys are liking these videos, send me an email, support@marketgeeks.com, or like this channel and give me feedback via the comments here. Talk soon.